Welcome to This Explainer. For years, we've basically been living in the era of flashy, incredibly beautiful financial apps. It was all about rapid user growth, totally ignoring actual profitability. But wow, the tide is definitely turning. We are moving away from this era of, fake banks and getting into the serious, highly regulated business of real banking and load-bearing infrastructure. It's a massive structural shift happening right now in consumer finance, and we're going to break the whole thing down for you, using the exact data and market signals right in front of us. There's actually a quote going around right now that just hits the nail on the head. It's giving the Truman Show energy in fintech today. Everyone's watching, waiting for the moment the fake bank finally becomes a real one. Think about it. For a long time, so many of these consumer finance apps were literally just a gorgeously designed user interface, a wrapper, sitting on top of somebody else's banking license. We all kind of knew it was a constructed reality, right? But now we're watching these beautiful tech wrappers being forced to grow up, tear down the fake set, and build actual profitable banking economics from scratch.
So here's our roadmap for today. First, the maturation of fintech. Second, why Chime desperately wants a charter. Third, the massive pay-by-bank infrastructure play. Fourth, how Monzo is totally proving the model. And finally, the overall future of finance. Let's dive right in.
Starting off with our first case study, Chime wants a charter and how they're outgrowing the wrapper.
Since they launched way back in 2012, Chime has really leaned into the whole, hey, we're a tech company, not a bank vibe. Right now, they route your deposits through sponsor banks, specifically Stride Bank and the Bancorp. Chime itself just owns the slick app, the brand, and the relationship with you. But looking ahead, Chime CEO Chris Britt basically admitted that getting a real OCC bank charter, which is pretty much the golden ticket of federal banking regulation, is absolutely a matter of when, not if. And the regulatory window is actually open right now. The OCC fielded at least 18 new charter applications last year alone. Chime is realizing that to really thrive, they've got to become exactly what they disrupted, a real bank with direct access to the Federal Reserve.
Now, why does this charter actually matter for Chime and its 9 million plus active members? Well, first off, it completely cuts out the middleman on every single deposit dollar. Huge. It also unlocks products that a sponsor bank setup just can't handle at scale. We're talking wire transfers, actual business banking, and high-yield money market accounts. And here's the real so what for you. Chime has an IPO coming up in June 2025. Post-IPO, investors are absolutely going to demand a long-term margin story. Getting this charter, kind of like how SoFi pulled it off back in 2022, is literally the only way to run the highly profitable economics of a real bank. You can't just be a pretty app relying on someone else's plumbing forever.
Speaking of plumbing, let's move to our next section, the pay-by-bank infrastructure play, and why owning the plumbing is absolutely everything. $700 billion. Let that massive number sink in for a second. That is the combined annual transaction volume now processing through NMI and Dwolla. Now, these are two payments infrastructure companies that you probably never see trending on social media, but honestly, that's by design. While everyone else is constantly arguing over flashy consumer app features, these guys are quietly moving nearly $750 billion in the background. Let's look at who these quiet giants actually are. You've got NMI, founded back in 2000 over in Illinois. They're this massive white-label embedded payments engine powering over 6,000 tech partners. They're literally the engine inside other companies' payment gateways. Then there's Dwolla, founded in 2008 out in Iowa. They're basically the API layer that businesses use to move money bank to bank via ACH and FedNow. Think of them as the high-speed digital pipes of the US financial system. Well, NMI just acquired Dwolla. And this is actually NMI's 6th acquisition in just 5 years, with Dwolla CEO Dave Glazer sliding right into the COO role at NMI. Guys, this isn't just a regular merger. It's a massive strategic consolidation of the underlying plumbing that physically moves your money.
And this projection perfectly explains why NMI made such a huge move. Juniper Research projects that global account-to-account, or A2A, transaction value is going to skyrocket from $91.5 trillion in 2026 to an unbelievable $195 trillion by 2030. It's set to more than double in just a few years. Every single time you pay directly from your bank account instead of swiping a credit card, you are part of this massive wave. This acquisition is a huge, calculated bet by NMI to own those rails as the whole war on card fees really heats up. Pay-by-bank isn't just a cute trend anymore. It's a heavy-duty, load-bearing infrastructure build-out.
All right, moving on to our third story. Monzo proves the model and the undeniable profitability of discipline.
So while a lot of American neobanks are really struggling right now with macro headwinds and super skeptical investors, Monzo, this UK digital bank led by their new CEO Diana Layfield, just quietly dropped their best results ever. We're talking their third consecutive year of profitability. Pre-tax profits surged 44% to £87.3 million. Revenue jumped 39% to hit £1.7 billion. And their total deposits up a massive 55%, reaching £25.7 billion. Listen, these are not just your typical tech bro vanity metrics. These are the rock-solid fundamentals of a maturing, highly successful bank.
When we actually peek under the hood to see where that money is coming from, it gets really interesting. Their main growth engine is heavily fueled by lending. Interest income alone hit £1.2 billion as they expanded things like overdrafts, personal loans, and credit cards. On top of that, business banking is now contributing a really solid 14% of their total revenue. Oh, and subscriptions added another £459 million in fee income. So they aren't just surviving off swipe fees from debit cards like the old days, they've actually built a diversified, real-deal banking revenue model.
But honestly, the most fascinating part about Monzo is how they pulled this off. It all comes down to a philosophy of extreme, ruthless discipline. You see American competitors constantly chasing growth in every direction at once, right? Well, Monzo did the exact opposite. They made the incredibly tough, disciplined choice to quietly shut down their unprofitable U.S. operations entirely this year, laying off about 50 U.S. employees. Instead of spreading themselves way too thin, they totally pivoted to dominating the UK market, and now they're very carefully expanding into Europe, hitting Ireland first and Spain next. They stopped trying to be everywhere and started truly owning their own backyard.
And wow, did that strategic discipline ever pay off? It is perfectly summed up by this one staggering statistic: 1 in 5. After adding 3 million customers in just 1 year, they've reached 15.2 million total customers. That means literally 1 in 5 UK adults now banks with Monzo. Just let that sink in for a second. 20% of the entire adult population in the UK trusts this digital bank with their money. It absolutely proves that the neobank model works, but only when it's paired with rigorous discipline and laser-focused geographic depth.
Let's tie it all together in our final section, the future of finance, where the plumbing is getting seriously interesting.
So what's the big takeaway for you from all of this? Simply put, the era of the fake bank is officially over. The fintech industry has unequivocally grown up. Whether you're looking at Chime aggressively pursuing an OCC charter so they can outgrow their sponsor banks, or NMI consolidating a $700 billion payment network to just own the underlying rails, or Monzo choosing deep local profitability over this impossible dream of global scale, all the signals are screaming the exact same thing. The market just doesn't reward beautiful apps with terrible unit economics anymore. It rewards real banks with real, load-bearing infrastructure.
Which leaves us with this final, fascinating question for you to ponder as you go about your day. As the underlying plumbing of the financial world gets more complex, more critical, and highly consolidated, take a quick look at your own phone. Are the financial apps you trust with your hard-earned cash every single day just beautiful tech wrappers? Or are they built on the load-bearing, highly regulated infrastructure of a real bank? I promise you, the answer to that question is going to define the entire next decade of finance. Thanks for joining me on this explainer, and definitely keep your eyes on the plumbing. It is getting very, very interesting.